for a tiny illiquid asset to have extreme price moves than a larger and more liquid and widely held asset. And so I'm not surprised to see that this cycle is more prolonged. But so far, I think it's on track. I mean, it continues to follow global liquidity measures as we'd expect. I do think that the 4-year halving cycle is increasingly less relevant because mining rewards are now a much smaller share of available coins. And instead, it's mostly about what price will unlock older coins. And so kind of the metrics that I track are, one, the market value to on-chain cost basis, to kind of see, how much euphoria is in the market at a given time. And then I also track like the HODL waves. So generally speaking, when you have bull markets, the percentage of coins that haven't moved in more than a year or two starts to fall because some of those older coin holders that are deeply in the money now, they tend to start trimming into that strength. And we've been seeing it market value compared to on-chain cost basis, because when that gets really far ahead of itself, you're more likely to get a correction. And in the prior major cycle tops, including 2021, that ratio reached extreme levels. So basically, the market value increased way faster than the on-chain cost basis, and then it took a lot of time for that to be digested. When we look at this cycle, we've not reached anywhere near those prior peaks of metrics like that. We've kind of reached, say, mid-levels of that metric. And none of the metrics so far show anything of extreme sentiment like we see it prior for managing it. Because at that point, the donors own it, the banks own it, it's tied in the financial system. So every kind of 4 years you give it to keep growing, makes it so the next 4 years kind of matters less from a political standpoint. So I'm not really worried about there being a political premium in it, even though obviously the election outcomes do matter for the asset class.
Yeah, that makes sense. Now,
a few ways to meaningfully reduce the deficit in any sort of investment time horizon, so call it 5 to 10 years. And therefore, I had the view that this is going to be very persistent, and therefore the market impacts from those deficits are likely to continue. So the main metrics I look at, one of them is demographics. So as the baby boomers started entering retirement years in the late 2010s at scale, there started to be a drawdown of Social Security, for example. And we started to see a disconnect where normally fiscal deficits are higher during periods of high unemployment and they're lower during periods of low unemployment. And we got a disconnect from that. So we started to see large deficits even during periods of low unemployment. And so they're disconnected from the economic cycle because they're more tied to demographics, more seniors collecting with a lag, like the next year. Generally speaking, tax receipts are not very good. And that's for a couple reasons. One, we have more wealth concentration than most other developed countries. There's more global capital stuffed into our stock market. We have, a lot of compensation is tied to stock prices, especially among high income, which pays the majority of taxes, and of course capital gains. So all these factors together makes that pretty strong correlation. So that means even when they do try austerity in some way, like they try to trim spending or try to increase taxes, it's likely to translate to kind of worse stock performance, which then ricochets back and hurts your tax receipts. So basically, where they are in this whole debt cycle, where they are in demographics, and then the highly polarized Congress that kind of makes major tax increases hard and makes major spending cuts hard. Slow motion runaway fiscal spiral. Bitcoin, gold, high quality equities priced at reasonable valuations, high quality real estate priced at reasonable valuations. Generally speaking, I like the global assets the best, so that's Bitcoin and gold. And between the two, Bitcoin is the faster horse by far.
So you often claim that the devaluation of fiat currency is inevitable, given this unstoppable trend of that growth. But what if are we underestimating the resilience of the fiat system? What if, for example, technology could come into play with technological deflation? So when technology improves, things get...
Presses white-collar wages, allows way more white-collar output for things. If we keep the energy flowing and things like that, then those fiscal deficits are more likely to show up in asset price inflation. And so either way, if the number of dollars is increasing substantially, you want to own the highest quality scarce assets. So if, for example, we have no bottlenecks in energy, it doesn't necessarily follow that oil is going to go up in dollar terms, even though there's a lot more dollars, say 5 years from now, than there are now. On the other hand, if that's happening, we're not making more Bitcoin other than the marginal amount that's still being mined. And so the highest quality assets, whether it's Bitcoin, gold,
blow up and essentially trigger a domino effect similar to the ones we saw in previous bear markets. What do you think? Do you see those concerns as justified?
Well, leverage is always a risk. And this is, this type of thing has been going on in currency markets for a long time. A carry trade where people will borrow in one currency that they perceive as weak, and they'll use it to get another currency that is either higher yielding or likely to appreciate relative to the currency that they're borrowing. And it tends to be a rather leveraged trade. Bitcoin is similar. I mean, it doesn't pay any native yield, but it's scarce and has a lot of price appreciation potential. And so much like you would borrow an emerging market currency, I do think that by the end of the cycle, I'd be surprised if we don't see at least one of these blow up. It comes down to some of these are going to buy in late when there's more signs of euphoria in the market. Some of them might not term out their debt appropriately. So we saw before MicroStrategy got through the prior bear market because they appropriately termed out their debt, and they continue to term out their debt. There could be newer entrants that don't manage this as well. They get overeager, they're less savvy the way they construct things. That's certainly possible. Most metrics, I'd be surprised if we don't see another, 30+% move or more that would get us up to that kind of that higher level. There are certainly higher numbers that I wouldn't be surprised at all. I'll reassess if we reach those numbers to see if there's still more to go. But basically, I think we're in a longer cycle. Maybe less extreme, but still, summers and winters, still bull markets and bear markets, and I tie them less to the 4-year halving cycle and more toward pockets of euphoria, pockets of depression, as well as the supply-demand cycle. So what kind of higher prices unlock older coins, and what kind of consolidations stop those older coins from getting to the market. I'd say most metrics.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.